Hi, I'm Adam DeSanctis. Welcome to MBANow. MBA's research team just released its March forecast, and it comes at a very important time given all the uncertainty right now in the economy. Here to talk about that is MBA's chief economist, Mike Fratantoni. Mike, thank you for being here today.
Thanks, Adam. Good to see you.
So the Federal Reserve just announced its ninth consecutive rate hike at its latest meeting amidst all this uncertainty and volatility that we're seeing in the financial markets. What do you make of this, and what are you expecting for monetary policy going forward?
Well, they did raise another 25 basis points, so the target's between 4.75 and 5. That was what we were thinking they were going to do. It's really a tension, right? Because inflation is still running about 3 times as high as they would like it to be. But as you mentioned, now you have this financial instability, the bank failures we've seen, the concerns about supply of credit to the economy. So a real challenge for them. In our latest forecast, we think they're going to hold at this level through the rest of this year. And then by that point, inflation should have subsided enough. We'll see rate cuts by the time we get to early 2024.
And it's interesting. You look at the economy right now, the job market's strong. Q4 GDP last year was close to 3%. But I know earlier this year you were expecting a recession at some point this year. Are you still holding to that forecast?
We're still expecting a recession. We have seen a number of leading indicators really point to that, and now on top of that, you had financial conditions which were tightening even before the latest couple of weeks of bank issues, and now after that, we think credit conditions are really going to tighten up pretty quickly. So I think we're going to get a recession, but as you said, the job market data continues to be really quite strong. So 311,000 employment gain in February. We think that'll be slowing and it'll turn negative sometime this year, but at this point at least, unemployment's still very low.
And let's turn to mortgage rates. Our weekly application survey in recent weeks rates have come down a little bit from recent highs. Where do you see them in the next coming months into the rest of the year, and what would that mean for the purchase and refi market?
We've been in a range, call it 6.25 to 6.5 over the last couple of weeks. A lot of rate volatility still. And one thing that does is it really pushes up the spread between a mortgage rate and a 10-year Treasury rate. We've seen that as high as 3 percentage points recently. And less than 2 would be more typical. If some of this volatility can just back off a bit, and we think that could happen once the Fed really announces that they're done hiking rates, I think that spread will come in. So we're holding to our forecast of rates below 6 by the middle of this year, getting closer to 5.5 as we get towards the end of the year.
And I think that will be good news, obviously, for the purchase market. And turning to that, we've talked for years now about the lack of supply in the housing market, and especially home builders' ability to build new homes. Recently, the stress that we're seeing in the banking sector, especially for some of those smaller and mid-sized banks, a lot of home builders get their financing from those financial institutions. Are you concerned at all about builders' ability to build?
There's really sort of a difference between the larger builders who get more access to public financing in the capital markets versus those that are reliant, as you said, on sort of small and mid-sized banks. So I think this is probably a market where more of the business is going to shift towards those bigger builders because those smaller builders are more likely to be constrained, exactly. And then I would just point out on the existing home side, 2.5 months of supply. We are definitely in a supply-constrained market. And the other thing that'll do is push some demand that would have gone into the existing home market into that new home market.
It's interesting. You see a lot of people are sitting on those very low rates right now, and maybe just with the uncertainty and wanting to stick to that current rate that they have, or not putting their house up for sale. So we'll be interested to see how that goes looking forward. And Mike, I've really enjoyed this conversation as always with you. We're a couple days before the end of the first quarter of this year. What's one thing that has surprised you so far this year?
This challenge with respect to financial market uncertainty, it's not just in the U.S. So I think the news over the weekend a couple of weeks ago about Credit Suisse being acquired by UBS, that shook the world. Credit Suisse was an institution more than 2 times as big as Lehman, right? So just think about that in terms of the impact on the global financial system and the concerns about Deutsche Bank, others. I think we got to look globally for sort of where the next spark might be in this uncertain situation.
And I know you will be following that closely. And again, thank you for joining us today.
Thanks, Adam.